Let me tell you, business is all about trust. When you're making a deal with someone in your own city, you can look them in the eye, you can shake their hand. But what happens when your customer is 5,000 miles away, across an ocean, speaking a different language? That's a whole different ballgame. You can't just send millions of dollars worth of product and hope you get paid. That's not a business plan, that's a gamble. And in business, you want to eliminate gambles. You want to manage risk. This is where trade finance comes in. It's the system that makes global business possible. Think of it like this. Trade finance is the financial plumbing of global commerce. It's a set of tools and services that help companies buy and sell goods across international borders. It's all about managing the money and the risks involved. Imagine a small business in Canada that wants to sell maple syrup to a supermarket chain in Japan. The Canadian seller wants to get paid before the shipment leaves the port, but the Japanese buyer doesn't want to pay for a container of syrup until they know it has arrived safely and is exactly what they ordered. It's a classic standoff. Who moves first? This is the core problem that trade finance solves. It bridges the gap of trust between the buyer, the importer, and the seller, the exporter. Instead of the two companies dealing directly with this payment risk, they bring in a third party, usually a bank or financial institution. This institution acts as a trusted middleman. It guarantees that the seller will get their money and the buyer will get their goods. It turns a risky international transaction into a secure, predictable process. Without this system, very few small or medium-sized businesses would ever take the leap into the global market. The risk would just be too high. So at its heart, trade finance isn't just about money. It's about building confidence. It provides the security needed for a deal to happen between two parties who don't know each other and are separated by vast distances, different laws, and different currencies. It ensures that the exporter gets paid for their goods, often even before the buyer receives them. And it gives the importer peace of mind, knowing their money is safe until the terms of the deal are met. It's the essential handshake that connects businesses across the globe, making sure everyone can sleep at night while goods are moving on ships, planes, and trucks. So how does this all work in practice? It's not magic, it's a set of smart financial tools designed for specific situations. The most famous one is the letter of credit, or LC. This is a classic for a reason. An LC is basically a promise from the buyer's bank to pay the seller's bank a specific amount of money, as long as the seller provides certain documents proving they shipped the right goods. These documents could be a bill of lading, an inspection certificate, or an insurance policy. The bank deals with the documents, not the goods themselves. It's a rock-solid guarantee for the seller. Another key tool is an import loan. Let's say you're an importer. You need to pay your supplier overseas, but you won't have the cash until you sell the goods to your own customers. An import loan, sometimes called a pre-export loan for the seller, provides the short-term cash you need to make the deal happen. It's a loan specifically to finance the purchase of goods for resale. This keeps your cash flow healthy, so you don't have to tie up all your working capital waiting for a shipment to arrive and sell. It's about financing the gap between paying your supplier and getting paid by your customer. Then there's something called factoring. This one is great for exporters who want their money fast. Let's say you've shipped your products and sent an invoice to your international buyer, but they have 90 days to pay. You can't wait that long. With factoring, you sell that invoice to a third-party company, the factor, at a small discount. The factor pays you most of the invoice value, say 80%, immediately. They then collect the full payment from your buyer later and pay you the remaining balance, minus their fee. You get your cash right away, and the factor takes on the risk of collecting the payment. Finally, we have export credits. These are often supported by governments to encourage companies to sell their products abroad. An export credit agency, or ECA, in the seller's country might offer a loan directly to the foreign buyer to purchase the goods. Or it might provide a guarantee to a commercial bank that finances the deal. This makes the financing cheaper and more secure for the buyer, which makes the seller's products more competitive. It's a way for a country to boost its own economy by helping its businesses succeed on the global stage. It's smart, strategic, and good for business. Global trade is a team sport. No single company can do it all alone. You need a whole cast of characters, each playing a specific role to make a deal happen smoothly. First and foremost, you have the importer and the exporter. These are the stars of the show. The exporter is the business selling the goods or services, like a US tech company selling software to a client in Germany. The importer is the business buying them, like the German company that needs that software to run its factory. Their goal is simple, to complete a transaction successfully, but they both have opposite risks. The most important supporting players are the banks. We're talking about both the importer's bank and the exporter's bank. These institutions are the financial quarterbacks of the deal. They issue the letters of credit, provide the loans, and handle the complex flow of money and documents across borders. They have the expertise, the global network, and the balance sheets to take on the financial risks that the importer and exporter can't. They are the ones who verify that all the rules of the deal have been followed before releasing any funds, making them the ultimate arbiters of the transaction. Then you have the government-backed players, like export credit agencies or ECAs. Think of these as the special teams. Almost every major trading country has one. Their mission is to promote exports from their home country. They do this by providing loans, guarantees, and insurance to cover risks that commercial banks might not be willing to take on, especially for deals in politically or economically unstable regions. They help level the playing field for their country's businesses, making it easier for them to compete globally and break into new, challenging markets. They are a powerful ally for any exporter. Finally, you have other crucial specialists like multilateral development banks and insurers. Multilateral banks like the World Bank often finance large infrastructure projects in developing countries, which creates massive opportunities for exporters. Private insurers offer specific policies to cover risks like cargo getting lost at sea, a buyer going bankrupt before paying, or political turmoil in a country preventing a payment. Each player has a job to do. Together, they create a safety net that allows billions of dollars in goods to move around the world every single day. It's a complex but beautifully coordinated dance. So why should you care about all this? Because trade finance is not some abstract concept for bankers and skyscrapers. It's the invisible engine that powers the global economy and affects your daily life in ways you might not even realize. Every time you buy coffee from Colombia, wear clothes made in Vietnam, or use a smartphone assembled in China, you are feeling the effects of a successful trade finance transaction. Without these financial tools, international trade would slow to a crawl. The variety and affordability of products we take for granted would simply disappear. For businesses, especially small and medium-sized ones, trade finance is a lifeline. I see it on Shark Tank all the time. Entrepreneurs with a great product who want to go global. The biggest hurdles are always financing and risk. Trade finance directly tackles both. It unlocks working capital, allowing businesses to grow without being crippled by cash flow problems. It removes the fear of not getting paid, which encourages more companies to look for customers beyond their own borders. It turns the entire world into a potential market, fostering innovation, competition, and growth for businesses of all sizes. The benefits ripple out to everyone. When businesses can trade more easily, they create more jobs. Competition from abroad forces domestic companies to become more efficient and innovative, which leads to better products and lower prices for consumers like you and me. It allows countries to specialize in what they do best, whether it's making cars, growing avocados, or designing software. This global division of labor makes the entire world economy more productive and raises the standard of living for millions. It's a system that, when it works well, creates a win-win-win situation for exporters, importers, and consumers. In the end, trade finance is about more than just money and documents. It's about connection. It builds the bridges that allow a farmer in Kenya to sell tea to a family in England, or a small factory in Ohio to sell machinery to a builder in Brazil. It is the foundation of trust upon which our interconnected world is built. It reduces friction, minimizes risk, and keeps the gears of global commerce turning smoothly. It's a critical, though often unseen force that ensures the goods of the world keep moving, businesses keep growing, and our global marketplace continues to thrive.